and 6, 7, they're related. It's basically they share the same facts. So example 6.4 gives us some information about a company's acquisition of another company's shares. And then it asks us to calculate the amount attributable to non-controlling interest, assuming, and then there's a bunch of scenarios. Now, I want to talk a little bit about non-controlling interest. So NCI, the definition of non-controlling interest is they are shareholders of the subsidiary company other than the parent, right? So the parent company has control. The other shareholders who do not have control are called non-controlling interest, NCI. If the subsidiary company's got preferred shares outstanding, and we're talking about simple preferred shares here, plain preferred shares, and if those preferred shares are not owned by the parent company, then the amount, the book value of those preferred shares is also included in non-controlling interest. So non-controlling interest can have a common share portion and preferred share portion. Okay? There are two acceptable methods for valuing non-controlling interest. They are fair value enterprise, the FVE method, and identifiable net assets. Now, the comparison between the two methods essentially reveals that they're fairly similar in the sense that non-controlling interests are given a share of, their share of. So if the parent company owns 80%, NCI will get 20% of the book value of the subsidiary, the fair value differences related to the subsidiary's assets and liabilities on the date of acquisition. And in the case of fair value enterprise, NCI is allocated goodwill, a portion of goodwill. Identifiable net asset says non-controlling interests should get book value and fair value differences, but they should not receive any share in goodwill. So essentially, what differentiates the two methods is whether non-controlling interest is to be allocated goodwill or not. Fair value enterprise says yes, non-controlling interest should also participate in goodwill, whereas identifiable net assets, the approach indicates no, non-controlling assets should not get any share in goodwill. Okay? Now, regardless, as I discussed in the lecture video, the total value of the subsidiary is equal to the acquisition cost for the parent company, whatever is the cost to acquire control by the parent company, plus whatever amount is allocated to non-controlling interest. So on the date of acquisition, the total value of the subsidiary consists of the acquisition cost for the parent company and the amount allocated to non-controlling interests. Now, how is this amount calculated? The fair value enterprise method is the default under IFRS 10, okay? So IFRS, if nothing is said, if there's no election made, fair value enterprise will apply, okay? And under fair value enterprise method, the FVE method, the most preferred approach is to use the market price of the subsidiary's common shares immediately after acquisition is completed. So what typically happens if you folks have an interest in the share markets and have been tracking merger acquisition activities over the last few years, you will find that usually whenever there is news about a company looking to acquire another company, making overtures to take over control over another company, it could be a friendly takeover, it could be a hostile takeover, depending on how receptive the board of the acquiree, the target company is to this, takeover, whenever the news breaks, the stock price for that target company shoots up, goes up. And the reason for that is people start speculating that if the intended acquirer, if that company is serious, they will be willing to pay a premium. They would be willing to pay a slightly higher price for the acquisition. And so that leads to people like, there are speculators that are, there's investors that, tend to invest for the long run. And then you have traders that, like to go in for short-term positions. And, they typically make bets on, okay, how hungry is this other company for this target and how high a price will they pay? Usually what ends up happening is that due to temporary supply-demand imbalance, the stock price goes up. After the acquisition is completed, though, more often than not, the stock price of the target company, it comes down. The reason is the euphoria is over, the party's over, the speculators basically exit that particular stock. There's already a parent company in place now. So what ends up happening is that the stock price comes down considerably. It's after the acquisition is completed. So whatever price that we arrive at after the acquisition is completed, if you believe in efficient markets, now some of you may have taken Accounting 434, the accounting theory course. And so you may kind of remember, you might be remembering some of this discussion from that class. So if you believe markets are efficient, then the stock price at any given point in time reflects all information that is publicly available about the company's prospects. So we go with that belief, and we say after the acquisition is completed, the market price of the target company, the acquired company, the subsidiary here, is the fair market value, and that is the price that should be used to calculate the dollar value amount allocated to non-controlling interest. Use market price after the acquisition is completed. If that is not possible, so if the subsidiary is not a publicly listed company, then you don't have access to market prices. In that case, the next preferred approach is to bring in a valuation expert. Right? Bring in someone who is an expert at valuing businesses, and based on that valuation expert's report, apply an amount for non-controlling interest. The challenge there is that valuation experts cost money. They're not cheap. Their services are not cheap. And, there is an element of subjectivity involved even in the work of the valuation expert, right? If you call in more than one expert, quite likely you'll find that their valuations will differ, right? They will be different. So people often do not have come to the same conclusion, especially if they don't talk, right? If the people talk to each other, then yes, you might find some kind of consensus coming up. But if you ask two different experts at two different times, you might get two very different results. So, that creates an element of subjectivity to it. So you go, oh, well, I don't know. Do I want to pay a whole lot of money for an expert whose numbers might be subjective anyways? Well, in that case, you could use the approach that is followed in calculating value in use or impairment tests. And that approach is to estimate cash flows, the net operating cash flows from the subsidiary. You kind of do make a spreadsheet and try to do an estimate of cash flows over a number of years, use some kind of assumptions for growth and so on, and then try to calculate the present value using an appropriate discount rate. Right? You kind of do a cash flow, discounted cash flow analysis, basically finance in action. For those that have taken accounting theory, you might remember some discussion about Olson's model, right? So Jim Olson's model of valuing companies. Um, Again, the thing is, a model is only as good as the reliability of the estimates involved. So in order to make those cash flow, discounted cash flow calculations, the company management has to make estimates about future cash. And those estimates are, even if they are made in good faith, they are susceptible to errors of estimation. So, in terms of reliability, whereas the market price can be said to be an objective, more reliable sort of indicator, bringing in an expert or using discounted cash flows are less reliable. So what ends up happening is, if the above are not feasible, if market prices are not available because the subsidiary is a private company and we don't want to bring in an expert or do a discounted cash flow analysis, then what ends up happening is you can use the parent's acquisition cost as an indicator, as a basis for determining the value of the subsidiary, 100% of the subsidiary. So you can basically extrapolate from the parents, based on the parents' acquisition cost, you can extrapolate the value of 100% of the subsidiary and then allocate the difference between what the parent paid for their share and what the total implied value is to non-controlling interest. This is the, I would say, least preferred approach as far as standard setters are concerned, but this happens to be the most commonly used approach, at least in an advanced financial accounting course. So if you go through problems at the end of the chapter for the book, if you look at CPA exams, et cetera, you'll find that using the parent's acquisition cost as a basis is the most commonly used approach. All right, so what is most common is not, unfortunately, the most preferred as far as standard setters are concerned. So there is a gap between real life and the course, okay? So we will be using this use the parent's acquisition cost as a basis for, when we get into the long, complicated consolidation problems, we are going to stick to this last approach, which is the easiest of the lot. However, do keep in mind that NCI, in real life, non-controlling interest ought to be computed these ways, or it is permitted that the company can choose to use the identifiable net asset method, where essentially what you do there is allocate to non-controlling interest their share of the book value of the subsidiary and the fair value differences for all the identifiable assets and liabilities. No goodwill, right? No goodwill is allocated. Okay, is that conceptually reasonably understood? Okay. The second thing I want to highlight is that there is a direct relationship between total goodwill and the value allocated to non-controlling interest. Now, notice that the total amount for the subsidiary, so as far as the total subsidiary is concerned, the total value of the subsidiary is made up of book value, fair value differences, and total goodwill arising on the acquisition. Of this amount, the parent gets its share of book value, fair value differences, and goodwill. And depending on how non-controlling interest is valued, either NCI will get a share of goodwill or they won't. Now, if NCI does not receive a share of goodwill, then this total goodwill number will simply represent the parent's share. There would be nothing allocated to goodwill. If NCI is lower, the total goodwill will be lower as well. And that is demonstrated by means of examples 6.4 and 6.7. Okay, so I'm going to show you examples 6.4 and 6.7. In example 6.4, the requirement is simply to calculate the non-controlling interest. And then in 6.7, the requirement is to calculate the goodwill. Okay, so I've set things up here. Please do not get overly lost here. Try to follow along. I'm going to work through in a very, very, very methodical manner. But do ask me questions. Do not hold back to your questions because you're likely going to forget your question. So first thing we are interested in is non-controlling interest in 4 scenarios. We're given information on this company, Alpha Company, acquiring 75% of the 100,000 outstanding common shares of Beta for $600,000. On the acquisition date, Beta Corp's shareholders' equity consisted of preferred shares, 100,000, common shares, 150,000, and retained earnings, $250,000. The book values of Beta Corp's assets and liabilities were also equal to their fair values, except for equipment whose fair value exceeds book value by $50,000. Remember, for fair value differences, we make use of this 2x2. Understated assets, the difference is a positive. Overstated assets, the difference is a negative, and so on. We have bonds payable, a liability whose book value exceeds fair value, i.e. these bonds payable are overstated. The equipment was understated. The company Beta Corp also owns an unrecorded broadcasting license worth $100,000. So unrecorded means clearly understated. And Beta Corp also had goodwill on its books amounting to $50,000. Now, if the subsidiary company has any existing goodwill on its books, that existing goodwill at the time of the business combination is basically considered to be worthless, i.e. it has a fair value of 0. Now, this is not seen as a fair value difference. This is basically, assumed that any existing goodwill on the books of the subsidiary will be, from the parent company's perspective at the date of acquisition, is basically charged against retained earnings. So net book value of our friend Beta Corp will be $150,000 for common shares, $250,000 for the retained earnings, and this goodwill of $50,000 will be subtracted from the retained earnings, right? So it's assumed to have been charged off against retained earnings. Now, I didn't really show that to you folks when I showed you net assets, because the purchase of net assets, the result is the parent company gobbles up all of the assets and liabilities of the acquiring company, records them on its own books, and away it goes its merry way, right? Doesn't have to bother with the other company ever. In the case of purchase of shares, though, the situation is different, right? The two companies continue to operate separately. And so Beta Corp will continue to operate. Beta Corp will continue to have its own balance sheet, and Beta Corp's assets and liabilities will be unaffected. Like its balance sheet will be unaffected by the mere act of it being acquired, the shares being, a majority of its shares being acquired by Alpha. So in this scenario, we have to be a bit mindful and we have to be a bit assertive. And so if there is any existing goodwill on the books of Beta Corp, the acquired company, the company that was taken over, then that goodwill is assumed to have been charged against its retained earnings. So you want to subtract the existing goodwill in the books of Beta against retained earnings. All right. So we'll come back to this again. I'll try to explain it again in case you didn't get it the first time. What's the specific requirements though? Specifically, the question's asking about calculating the amount attributable to non-controlling interests. Assuming in the first case that Beta Corp's shares are not publicly traded and that Alpha's acquisition cost is to be used as a basis for calculating the common share portion of non-controlling interest. So what is NCI? NCI will have a common share portion. Total NCI will have a common share portion and it will have a preferred share portion. The preferred share portion is basically $100,000. Alpha Company, there is no indication here that Alpha Company owns any of the preferred shares issued by Beta. So all of these preferred shares, the $100,000 worth of preferred shares, are included in non-controlling interest. Yeah. So there's going to be $100,000 of NCI preferred. Now I'm just going to throw that. Okay, there's no numbers. So let me just write that down. $100,000 of NCI preferred in each of 4 cases. In order to get total NCI though, total NCI needs not just the NCI preferred, but also the amount allocated to the common share portion of the non-controlling interest. So we will be calculating that part, that in each of these parts. In part 1, we're told that we must use the acquisition cost for the parent company as a basis for calculating NCI common. Now, if you take a look here, Alpha bought 75% of shares of Beta and paid $600,000 for it. So acquisition cost of 75% of Beta Corp's common shares is $600,000. So if we want to use the cost paid by the parent company, this $600,000, if $600,000 is 75%, how much is non-controlling interest? It's 25%, right? So if 75% is equal to $600,000, then how much is 25%? How many dollars is that? Hugo's already offered an answer. So Paige agrees it's 200,000. What about the rest? If 75% is 600,000, how much is the remaining 25%? So I'm getting a couple of conflicting numbers. Pardeep and Preet are saying 150,000. So think, if 75% is 600,000, how much is 100%? 600,000 divided by 75% works out to 800,000. So if NCI is the difference, if the total value of Beta is 800,000, then 800,000 minus the 600,000 works out to 200,000. Alternatively, what you can do is you can say, well, if 75% is 600,000, 1% is 600,000 divided by 75. 25% is 8,000 times 25, 200,000. right? So you can kind of, yeah, exactly. You can do it any which way, right? You could take the so if you're using the parent's acquisition costs, most easy will be to calculate the implied value. So just say, okay, if 75% is 600,000, then 100% is 600,000 divided by 75%. You get the, so as Hugo says, divide the acquisition cost by the percentage owned, you'll get 800,000. And then 25% of 800,000 is 200,000. Okay, so you don't want to multiply 25% of 600,000 because the 600,000 is actually equal to just 75%. All right, 75% is 600,000, 25% will be 1/3 of that, 200,000. So in this case then, NCI common is rather $200,000. Total NCI, therefore, is 200,000, the common share portion, plus 100,000, the preferred share portion. So that adds up to $300,000 total. Okay. Is that understood, folks? Now that is a separate matter altogether, Hugo. Minusing the pre-existing goodwill. We'll do that when we do the calculations for 6-7. When we are calculating goodwill, the acquisition goodwill, then we'll go down. But if you're just looking to calculate non-controlling interest, this is your math. The common share portion of NCI plus the preferred share portion of NCI gives you total non-controlling interest, 300,000. So we're just trying to do 6-4 here. We'll do the rest. We'll do the remaining good part and come. I just don't want to get people too confused, right? Just doing non-controlling interest, that's all you want. You want the common share portion and you want the preferred share portions. Add them together, you get 300,000 total NCI. All right. Because keep in mind, you could also see some, there will be multiple choice questions on the final exam. And, you could see a fairly innocuous looking question asking you for non-controlling interest, giving you a little bit of information there. You don't want to sit down and do a lengthy calculation. You should be able to zoom in and pick up exactly what's needed. Yeah. If you're asking about non-controlling interest, and in part 1, the non-controlling interest is $300,000. All right. Okay, let's see part 2. If Beta Corp is publicly traded, well, then there would be a market price. And its shares had a market value of $7 immediately after the acquisition date. Now, just answer me this. Alpha Company bought 75% of 100,000 shares. So how many shares did Alpha Company buy? The number of shares. 75,000. And they paid $600,000 for it. So what price did they pay for each share? They bought 75,000 shares for $600,000. What was the price per share? $8. Now, Alpha Limited bought the shares at $8. Once Alpha Limited completed their acquisition, the market price of Beta Corp shares fell to $7. I was explaining that. Yeah, that happens. The stock price, after the acquisition is completed, falls. So there was a 12.5% fall in the price. we want to use the market price immediately after the acquisition is completed here, right? Because that is um, a more objective measure where control premium is taken out of the picture. You get the value, a valuation of the subsidiary minus the control premium. Of course, Alpha Limited, when they wanted to get control, they had to pay a higher price, right? The higher price includes a premium, an extra amount paid by Alpha Company in order to get the number of shares they needed to get so that they would be in control over Beta. Does that make sense? They were like, in order, like not everybody wants to sell at whatever the market price is. You know, if you really want to buy, you got to make the price a little bit sweeter. So that's understood, right? When, you know, think of, you've probably seen this, you know, developers trying to buy out small bungalows. You know, they want to buy out an entire block so that they can rezone and construct, you know, apartments, condos over there. And there's that one person that doesn't want to sell because, you know, they know they've got the developer by, you know, an interesting place. And so if the developer wants to complete the acquisition, they will have to pay more than the so-called fair market value, right? It will still be a market transaction, but the price paid will be much higher. Kind of get the picture, yeah? So for Alpha Company, they had to pay $8 a share. But after the acquisition was completed, the price of the shares was $7. If that's the case, how many shares do NCI own? If 75,000 shares are owned by Alpha, Hugo says 25,000. So non-controlling interest, the common portion, will be 25,000 shares. And if each share trades at $7 per share, how much is that worth? 25,000 shares at $7, 175,000, exactly. So the answer to part 2 is non-controlling interests will have a value of $7 times 25,000, 175,000. That 175,000 is the value of NCI common. Add to that $100,000 for NCI preferred, and we get total non-controlling interest, $275,000. Does that make sense? Here, we didn't have to even think about the acquisition cost of the parent, etc. We just used the market price. Make sense or no? Yeah? Okay. What about part 3? An independent business valuation expert determined non-controlling interest common portion to be 160,000. So we brought in an expert, and the expert said, in their esteemed opinion, non-controlling interest should be worth 160,000. So, well, if you brought in an expert and the expert says NCI common is 160,000, in part 3, how much is NCI common worth? You chose to rely on the expert's opinion. The expert says 160,000. So what's the value of NCI common? NCI common, Firoz, 160. Right? So NCI common is 160. Well, add to that the 100,000 for the preferreds. And yes, you get total NCI. You gave me the answer for total NCI. Yeah, you just need to be, so this is what I'm trying to get at. You know, when you folks write exams and so on, oftentimes, you know, we try to save on, you know, those ephemeral seconds, and we read very quickly and we don't read attentively and we end up choosing the wrong answer. Because certainly 260 would have been part of, if this was a multiple choice question, there would have been 260,000 in there somewhere. And if you didn't read the question carefully, you would likely choose 260. And if the question was, how much is NCI common? And you chose 260,000, your answer would be incorrect, right? Your answer was right, but you answered, my question was wrong, maybe, right? I mean, I can apologize. Sorry for asking the wrong question, but you get it, right? So that is something that you have to develop, folks. It's not that this stuff is hard, but because there is so much, sometimes it can become a little overwhelming, and we make mistakes, not because we don't know the material, it's just because we misread or we misinterpret what the question's asking. So the harder this stuff gets, the keener your reading needs to be. You cannot afford to just make a guess about what the question's asking, because you will end up wasting your time there. Right? So that went very quickly. Part 4. NCI common is calculated under the identifiable net assets method. What did I say about the identifiable net assets method? Under this method, NCI is allocated its share of book value and fair value differences. So we want to first calculate the net book value of Beta Corp. Now, net book value of Beta Corp is common shares. So we're just talking about the common shares portion. The preferred shares are put on one side. We're not even touching them. So net book value of Beta Corp here will include common shares. Common shares were 150,000. Retained earnings, 250,000. And Beta has existing goodwill on its books worth $50,000. So 150 for common shares, 250 for retained earnings. And then goodwill, the existing goodwill, I want to subtract. So if I add that up, I get $350,000 for net book value. Now, under the identifiable net assets method, NCI is going to get 25% of net book value, which is 350,000. So they're going to get 25% of 350,000, but that's not all. They will also get 25% of the fair value differences. And if you look at the information here, we have fair value differences for the equipment, the bonds payable, and the license. The equipment is understated by 50,000. Fair value is more than book value. Understated assets, the difference is a positive. So equipment, $50,000. The bonds payable liability, book value is more. So the bonds payable liability is overstated. Overstated liabilities, the difference is a positive. So another 50,000. And then the broadcasting license is unrecorded. It's worth 100,000, but it's not recorded on the books of Beta. So that's entirely understated. Understated asset, $100,000. So if I were to add up all of these fair value differences, I get another $200,000. So 350,000 is the net book value. 200,000 is the fair value differences. And remember, under identifiable net assets, non-controlling interest will get their share of, so 25% off, the net book value, which is 350,000, and the fair value differences, which is 200,000. So I just showed the explanation here. The actual calculation works out to 25% of the 350,000 plus the 200,000. for 137,500. Under INA method, non-controlling interest will be 137,500. All right, so I had to calculate the book value and I have to calculate the fair value difference. Now, why did I specifically do that calculation here? I'm trying to kill two birds with one stone. Like, I'm not a cruel person. I'm not anti-animal or anti-birds. I'm just thinking because I have to calculate goodwill anyways as part of example 6.7. So doing this actually helps me complete example 6.7 as well. And it also helps me get the book value and the fair value differences that I needed for the NCI under identifiable net asset. All right, is that understood? The 137,500 is what I want you folks to understand first. You get how I got that? It's NCI's share of net book value of the subsidiary and fair value differences. When we calculate net book value is common shares plus retained earnings. If there is any existing goodwill, you got to minus that. So are we good with 137,500? Sure? All right. So to just wrap up part 4 then, NCI common is 137,500. Add to that the $100,000 for the NCI preferred, and we get total non-controlling interest in terms of part 4, the INA method, 237,500. These, my friends, were the answers to example or exercise 6.4. These are your answers. Part 1, the answer is 300,000. Part 2, the answer is 275,000. Part 3, the answer is 260,000. And part 4, the answer is 237,500. Okie dokes. All right. Now, example 6.7 said, refer to the facts provided in example 6.4 and calculate the goodwill in each case. I go back to part 1. Acquisition cost of 75% of Beta Corp's common shares, 600,000, plus the NCI, 200,000, works out to total value for Beta Corp, $800,000. The parent company, Alpha, controls. So when you control all, okay? You might not own all of the subsidiary, but when you control it entirely. Control is always, it's either 100% or it's 0. You can't have something like, oh, I have 60% control. That's only theoretically possible in the case of a joint venture, but otherwise it's never possible. Like I can't say, oh, I was driving my car downhill and I was I think 40% in control. Either I had control over my car or I was yelling, good Lord, dear Lord, help me, right? I either was in control or I was not in control. There's no such thing as partial control, okay? At least in the world of acquisitions, business combinations. So when Alpha Limited got control over Beta, even though Alpha Limited only bought 75% of Beta, Alpha Limited controls 100% of Beta. And under part 1, we said we determined the value of Beta Corp to be $800,000. So what does that mean? That $800,000 valuation is embodied in the form of $350,000 net book value. So out of the 800,000, 350,000 is the net book value. So the 800,000 valuation results in an acquisition differential of 450,000. So the act of acquiring, the act of acquisition has resulted in a valuation differential of $450,000. Comparing to the book value, there is a value difference of 450,000. That acquisition differential, you will remember, I hope, from our discussions of investments in associates and investments in joint ventures. That acquisition differential is first allocated to the fair value differences. So these fair value differences add up to 200,000. Out of the 450,000, if $200,000 can be explained with reference to fair value differences, what cannot be explained is 450,000 minus the 200,000, or goodwill 250,000. So in part one, goodwill came in at $250,000. Now this is total, okay? These are all total values. And why am I taking total? When I was doing investments in associates, I was multiplying everything by the investor's share. When we did joint ventures, we were multiplying by the venturer's share. Here, though, the acquisition results in 100% control. So Alpha Limited is in control of all of Beta. And if all of Beta Corp is worth 800,000, Alpha Limited, by dint of its control, is at the command of, or is able to command, $350,000 worth of net book value. They have command control over $200,000 worth of fair value differences, and what we can't explain with reference to tangible differences, we put under goodwill. So there is a total goodwill of 250,000. Okay. Does this make sense? All right. Now, if you're kind of thinking, oh, what is it made up of? Well, remember, Beta Corp is made up of net book value, fair value differences, and goodwill. So we just determined here net book value is 350,000. Fair value differences are 200,000, and goodwill, we said, is 250,000. That's what gave us a total of $800,000 in valuation for Beta Corp, right? That's the total. Now, if you try to split it, if this is my total, the parent, Alpha, owns 75%. So what does Alpha own? Alpha owns 75% of 350,000, 75% of 200,000, and 75% of the goodwill, 187,500. So if you add up Alpha's portion, you get 600,000. Remember, the acquisition cost for the parent is 600,000. So when Alpha paid $600,000 for the 75%, this is what Alpha got. Alpha got net book value 262,500, fair value differences 150,000, and goodwill 187,500. What happens to the rest? Where did the rest go? Well, the rest went to non-controlling interests. NCI owns 25%. And when you do the math, 25% of the book value, 25% of the fair value differences, and 25% of goodwill works out to $200,000 the amount that we allocated to NCI. In part one, that's your explanation. NCI's 200,000 gives it 25% share of book value, fair value differences in goodwill. Alpha's 75% ownership gives it 75% of book value, 75% of fair value differences, and 75% of goodwill. But here's the interesting thing, Alpha Limited controls all. So even though ownership, a 25% ownership rests with non-controlling interest, when it's about control, Alpha Limited is in control of all of Beta. All of Beta Corp is controlled by Alpha. And that is why Alpha Limited ends up consolidating. Right? So these concepts are pretty important. They're pretty strong. If they are clear in your mind, you know, all these nitty-gritties are not going to be that challenging. You have to work on ensuring that you understand the why, because otherwise there's just too much stuff and we will get overwhelmed. We cannot memorize these things. We have to have a very clear understanding. So this acquisition results in control. Control is absolute. The parent company is in control over all of the subsidiary. When it comes down to ownership, the parent company owns just its share. NCI owns its own share. Okay, is that understood? Or rather, I should say, are there any questions about what we just talked about? No? Right. Okay, so that was the answer for part one. To answer part two, now the parent paid 600,000, right? So that's not changing. The parent company's paid $600,000 to buy 75% of Beta Corp. So the parent's acquisition cost plus the amount allocated to NCI. Well, in part two, we allocated 175,000 to NCI. Well, if I add those two together, I get a value for Beta Corp. So the total value of Beta Corp in part two is 775,000. It's not 800,000 anymore. It's 775,000. Right? That is important to keep in mind. In part two, the parent's acquisition cost is 600,000. NCI is allocated a value of 175,000. So the total value of Beta Corp in this case is 775,000. Now, what does that 775,000 involve? Well, there's $350,000 for net book value. So that number is indisputable. That leaves us with acquisition differential of 425,000. Next in line is the fair value differences. And these are, again, you know, if there has been negotiation involved, then this number also is fairly objective because it is a result of a market determined, or there has been expertise involved in allocating these fair value differences, right? So it's still more reliable. So 200,000. So what we are left with now is goodwill of 425,000 minus 200,000. We are now left with goodwill of 225,000. That's interesting. When you look at the total value of the subsidiary, notice we are going down. As we go down, our reliability, the reliability of those numbers reduces. Net book value, most reliable. Fair value differences, less reliable than net book value, but still is an outcome of some kind of negotiation process. Goodwill is simply what's left over, right? So goodwill is least reliable of the three. And so when you are shifting, as you shift from using the parent's acquisition cost as a basis to some other basis for calculating NCI, notice what's happening. Non-controlling interest, what happened here? Non-controlling interest was $200,000 in part one, but in part two, we said NCI common should be $175,000. So notice what happened with NCI. NCI went down by $25,000 compared to part one. In part two, NCI is lower by $25,000. Well, what happens to goodwill? Goodwill in part one was $250,000. In part two is $225,000, lower by $25,000. And that's what I meant. There is a direct relationship between total goodwill and NCI. What's the reason? Remember the good old-fashioned accounting equation, assets equal liabilities plus equity. NCI is reported in equity. So if the value in part two, if the value of NCI is lower, there has to be a corresponding lower number on the asset side. And that lower number is a lower amount for goodwill. If NCI goes down, goodwill goes down. Is that conceptually clear? The relationship between non-controlling interest and goodwill. All right. So now I'll invite someone to predict. So looking at part three, in part three, total non-controlling interest is $260,000. What do you predict will be the value of goodwill in that case? Of course, we can do the calculation, but if you were to just predict the value, so Hugo thinks it should be 210,000. If he says 210,000 as well, so I've got two people saying it's 210,000. So let's check. Well, if you do the long calculation, the parent company paid 600,000, so that doesn't change. Add to that the value allocated to non-controlling interest, and we get total value of the subsidiary beta 760,000. Out of that 760,000, 350,000 is for net book value. So acquisition differential in part three is 410,000. Then you have fair value differences, which are $200,000. Subtract the fair value differences from the 410, you get $210,000 goodwill. So again, notice there's a 15,000 drop for non-controlling interest. There's a $15,000 drop in goodwill as well. So goodwill and NCI go hand in hand. All right. Now, if we try doing that for part four, the parent's acquisition cost was 600,000. Total implied value 737,500. Includes book value 350,000. So I'm left with 387,500. Fair value differences, 200,000. Goodwill is 187,500. And that 187,500 is basically the parent's portion of goodwill. Remember, under identifiable net assets, when we compared the two, we said, well, under identifiable net assets, NCI doesn't get any goodwill. So the only goodwill that is in play is the parent's portion. And that's what we saw. The parent's portion is 187,500. Right? So this was part one. This is what happened. So NCI share in part one, this is what it includes. If you want to do the same thing for part two, you'll say, okay, I'm going to start with the total NCI here. So this is NCI common only, okay, by the way. This is only the NCI common. So in part two, NCI common was 175,000. Now that 175,000 is made up of 25% of 350,000. So that is most reliable. We give them 87,500. Then we give them 25% of the fair value differences. And then whatever it takes to make the total equal 175,000. So how much is NCI's share of goodwill in part two? So out of 175,000, if I subtract 87,500 and 50,000, I'm left with 37,500. Here's something to see. Total goodwill. In part one, so total goodwill is calculated as the parent's share of goodwill plus NCI's share of goodwill. So parent share 187,500. Non-controlling interest share of goodwill is 62,500. Notice I got my $250,000 back. Yeah, that was the total goodwill there. In part two, if you try to calculate it, the total goodwill, you get the parent's share 187,500. Add non-controlling interest share 37,500. Guess what? You get your 225,000 back. Again, this is proof of how non-controlling interest and goodwill go hand in hand. You can check that with part three as well. So you want to do part three? Same thing. Total value for NCI is, for NCI common, I should say, is 160,000. All right. Okay. If total value is 160,000, what does that include? It includes non-controlling interest share of net book value, which is 87,500. It includes NCI's share of the fair value differences, which is $50,000. And then whatever it takes to make the value of, oh, I did something weird here. Yeah, 37.5. So in part three, if you calculate how much of goodwill is allocated to NCI, you need the total to be equal to $160,000. So how much must be the share of NCI with regards to goodwill? 22,500 says you. Okay, let's check that. 22,500. Yes. So now if you calculate total goodwill, parent's share. So parent's share of goodwill doesn't change. It stays 187,500. Add to that NCI share 22,500, and you see you got your total goodwill 210,000. As NCI changes, so does total goodwill. Part four, if you must insist. NCI gets 25% of net book value and fair value differences. They don't get any goodwill, right? So they don't get any goodwill. And basically, if you were to calculate the total, that is your 137,500 right there. And total goodwill is just the parent company.